In this section, we are going to cover the gift tax. And you've probably all heard of the gift tax, but some misconceptions about the gift tax is that the person who pays the tax is the person receiving a gift. That's not the case. In the case of gift tax, it's the person making the gift who might be responsible for payment of a tax. And the gift tax and the estate tax are part of the unified transfer tax, and they work together. So, they work that way for the reason of preventing tax avoidance. So, if the gift tax and the estate tax didn't work together, I could avoid the estate tax by giving away all my wealth while I'm alive. Or if the gift tax did not exist, if the estate tax did not exist, I could avoid the gift tax by waiting till I die to give away all my wealth. So they work together. And they obviously have the purpose of raising revenue for the government, and they also have a purpose of avoiding wealth being concentrated solely at the top. And we have that issue now, but it could be worse if the gift tax and the estate tax did not exist. So the gift tax applies to gratuitous transfers of wealth. That means I give you something and I don't receive anything in return. Extreme modifications of the tax thresholds and rates have occurred throughout the years, and depending on which party is in control. Right now, the estate tax exclusion is huge, $10 million. Your estate can be valued at $10 million before you have to pay the estate tax, and that's indexed for inflation every year. So in 2018, that's actually $11.18 million when adjusted for inflation. And there's also a $15,000 annual exclusion for gift tax. Like I said, the exclusion is $15,000 for 2018. And the giver can make gifts to an unlimited number of people, and that's important. So while the exclusion is $15,000, that means I can give one person $15,000 before being subject to the gift tax. I can also give another person $15,000 before being subject to the gift tax. I can give as many people as I want $15,000 each before being subject to the gift tax. My spouse can also do the same. So I could give each one of you $15,000, and my spouse could give each one of you $15,000 before we would be subject to any gift tax liability. There's also a gift splitting election, which allows spouses to treat gifts made by one spouse to third parties as if each spouse made half the gift. And that's not as important here in Texas in a community property state, which Texas is. Remember, in community property, each person in a marriage is treated as collectively owning everything in the marriage. But in a common law state, that's not the case. I'm treated as owning what I brought into the marriage and what I earned in the marriage. So if a spouse doesn't work, a spouse doesn't have any assets with which to give. And also, same-sex spouses are eligible for this gift-splitting election. The gift tax is cumulative, so this is different than any other federal tax we've talked about. It's not merely an annual computation. And the unified credit is how the gift tax and the estate tax are tied together and how one prevents the violation of the other. The donor's estate at death includes the value of any adjusted taxable gifts at fair market value on the date of the gift. So any of those can increase the marginal tax rate on the date of death or on the estate at the time of death. The unified credit reduces dollar for dollar a certain amount of the tax computed on the taxable gifts or the taxable estate. The credit operates for both gift and estate taxes. And there's a basic exclusion amount, and that amount allows donors to make a certain amount of taxable gifts without the need to pay gift tax. That's that $15,000 a year, and that amount changes every year. And then the credit, the 2018 unified credit amount is $4,417,800. That is calculated based on the tax on the estate tax exclusion amount. So that $11.18 million estate tax exclusion that I mentioned previously, if we were to calculate the tax on that, it would be $4,417,800. Transfers subject to the gift tax are generally transfers for less than adequate consideration. So I get something that I have not paid for, or I give something and I don't receive anything in return. these are gifts. And we also need to look at a bargain sale versus transfers in the normal course of business. So if I get something that I've paid something for, but I haven't paid full consideration for, that's a gift generally. That's a bargain sale generally. But there is an exception for transfers in the normal course of business. If I say I'm going out of business and I sell everything for much less than it's worth, or than it's selling at other places, that looks like a bargain sale. But the IRS has said that if I sell things in the normal course of business, there's an exception to the gift rule that inadequate consideration constitute a gift. If it's in the ordinary course of business, it's considered to have been made for adequate consideration. So in problem 32, Beth, who's single, sells stock valued at $40,000 to Linda for $18,000. Later that year, Beth gives Linda $12,000 in cash, and we want to know what is the amount of Beth's taxable gift. So Beth sold stock to Linda, but she sold it to her at less than fair market value. We don't really know a lot about the relationship between Beth and Linda, but this doesn't say this is in the normal course of business. So we're going to assume maybe they're friends or related or something, and this is a gift because she sold it to her for less than it's worth. She also gave her $12,000 in cash. So in the current year, Beth has made 2 gifts to Linda, and we want to know the amount of Beth's taxable gifts. So obviously the stock was sold for $22,000 below fair market value, and there's a $12,000 cash gift. But also we need to remember that we have an annual exclusion of $15,000. So she made total gifts of $34,000 to Linda, but she receives an annual exclusion of $15,000. So her taxable gifts are $19,000, which is the 34 minus the 15. Notice too that it says Beth's taxable gifts because remember the person who pays the gift tax is the giver. All right, part B, how would your answers to part A change if Beth instead gave the cash to Patrick? So now Beth has made the exact same amount of gifts, but she's given it to 2 people. That is going to change things because remember that annual exclusion is a per donee exclusion. So she can exclude $15,000 for each gift she makes to different people. So for the sum total of gifts she makes to each different person. So here, Beth's taxable gift to Linda is going to be $7,000. It's the value of the stock that less the consideration she receives minus the annual exclusion. And the gift to Patrick is 0 because she gave him $12,000 cash. The annual exclusion is $15,000. So that wipes out the amount of his gift. So the taxable gifts for Beth this year are now $7,000. There are also statutory exemptions to things that would otherwise be a gift. The first is payment of medical expenses or tuition. A qualified transfer must be made directly to the medical institution or the educational organization for this to apply. So we can't give it to an individual directly and have that individual pay the hospital or the doctor or pay the university. We have to make that transfer directly to the college or the doctor or whomever. There's no requirement, though, that the payment has to be for a dependent. This does not have to be for my child or my dependent. This can be for anyone. If it is made for a dependent, however, it's going to constitute support and not a gift. And if it constitutes support, we're not subject to these other requirements that the transfer has to be made directly to the medical institution or the educational organization. Transfers to political organizations are also statutorily exempt. And property settlements in conjunction with a divorce are also statutorily exempt from gift tax consideration. Another exemption is a qualified disclaimer. This is going to be when someone stands to inherit something from a decedent. So in the will, they may stand to receive something, but they decide they don't want it. So in that case, they can disclaim it, and if they do, it's treated as if the property was never transferred to them. If the property was never transferred to them, there's no gift tax consequence when they give it to someone else. And this might happen if the person who stands to inherit maybe is really wealthy or for some other reason doesn't need these assets. So in order to meet the test for a qualified disclaimer, it must be an irrevocable, unqualified written refusal to accept the property. The transferor or his or her legal representative must receive the refusal no later than 9 months after the later of the day the transfer is made or the day the person named to receive the property becomes 21. The disclaiming person must not have accepted the property interest or any of its benefits, and as a result of the disclaimer, property must pass to this decedent spouse or a person other than the one disclaiming, and the person disclaiming may not direct receipt of the property. And that's important. So what that last bullet says is the person who's making this disclaimer can't choose where the property goes instead of them. So it has to be disclaimed, and it has to transfer pursuant to the decedent, and the decedent means the dead person. So it has to transfer pursuant to the decedent's will, or whatever instrument directed that transfer. The person who is disclaiming cannot direct where that property goes. And a gift is complete when there's cessation of donor's dominion and control. So a gift occurs and is valued when the gift becomes complete, which, like I said, occurs when the donor has no dominion or control over the asset. If this is easy, if we are transferring cash or a hard asset or something like that, but if we transfer something to a trust, sometimes it becomes a little more fuzzy. If I transfer assets to a revocable trust, which a revocable trust means I can revoke that trust. So if I transfer assets to a revocable trust that I can revoke and that I can change, I haven't really given up dominion and control of those assets. So in that case, there's no gift because the transferor can still change the trust provisions. And that's how a trust works, right? I give assets to this trust, and the trust is administered however I set it up. And trust can be revocable or irrevocable. If they're revocable, the maker of the trust can undo the trust, or they can change the beneficiary of the trust, or they can change any number of options in the trust. If a trust is transferred even to an irrevocable trust, it can be deemed an incomplete gift if the donor reserves any power of the property's disposition. So an irrevocable trust means I can't revoke it, right? I can't turn it off. I can't get my property back. But in an irrevocable trust, I could retain the right to change the beneficiary, or change when the beneficiary gets assets, or change something like that. And if I do retain that right, then it's going to be deemed an incomplete gift. And if it's an incomplete gift, then it's not going to be valued on the date of the transfer to the trust. All right, so like we said, valuation is generally measured as the fair market value on the date of the gift. This is easy if it's cash or another asset. I might get something else though. I might get a life estate with a remainder interest. So a life estate with a remainder interest is something like I have an asset, I have a house, and I want to live in this house till I die, and then I want it to go to my daughter. So I gift her a remainder interest, and I retain the life estate. And what that means is I get to live there until I die, and then when I die, she gets whatever is left over. That's a remainder interest. So in that case, generally the remainder interest is the only interest subject to tax. There can also be a term certain interest, and a term certain interest is property transferred in trust, giving another the right to receive income for a certain period of time, after which that's going to revert back to the grantor. So it's going to go back to the person making the gift. In that case, only that portion that's transferred is subject to the gift tax. And to measure these things, we use actuarial tables, and they're in your book in the back in the appendices. Actuarial tables are used to value life estates, annuity interest, remainders, and term certain interests. All right, we're looking at problem 39 now. Determine the amount of the completed gift, any, if any, arising from each of the following occurrences. A parent sells real estate valued at $1.8 million to an adult child who pays $1 million in consideration. All right, so this is a gift because We sold something for less than adequate consideration, and there's no exception that applies. This is not in the ordinary course of business or anything like that. So we have a gift, and the gift is measured at the fair market value minus the amount that the child paid, so $800,000. B, a furniture store holds a clearance sale and sells a customer a $5,000 living room suite for $1,500. All right, so this customer got a good deal, but this appears to be in the ordinary course of business, so no gift arises. C, during the year, a father purchases food and clothing consisting of $8,500 for his minor child. All right, so this is support, right? No gift occurs because he makes the expenditures for support of his minor child. D, a citizen contributes $1,500 cash to a political organization. That is one of the statutory exemptions to gift tax. I'm allowed to contribute cash to a political organization without incurring gift tax. E, Zeke lends $600,000 interest-free to his son Henry, who signs a demand note on August 1st. Assume 6% is the applicable interest rate and the note remains unpaid at year end. So it looks like Henry has to pay this loan back because he signed a note. So this does look like a valid loan. The only difference between Henry getting that money from his father and from a bank is that Henry isn't paying any interest. So there will be gift tax consequences here, but it will just be of the interest that Henry is not having to pay. And so the applicable federal interest rate is 6%, so we're just going to calculate 6% times $600,000, and then we're going to figure out how long the loan has been outstanding, because remember, interest is a function of time. So in this problem, the loan has only been outstanding 5 out of 12 months. That 6% rate applies to the whole year. So we're going to take 5/12 of 6% times $600,000. The $15,000 of foregone interest is the measurement of the gift. But what does that amount tell us? Well, it tells us there actually will be no gift tax consequences to Henry's father because that annual exclusion amount is $15,000. So Henry's father, Zeke, will not have to worry about any gift tax consequences. And there are also some interesting transfers we don't really think about that would create a gift, but that do. So the first is creation of a joint bank account. If two people contribute money to a joint bank account and one contributes more than the other, they both own the funds in that account. So when the transfer is made to create the account, there's no gift tax, but there will be a gift if one withdraws more than he or she deposited. That would be completion. The gift would be completed that date, and there would be gift tax consequences there. There also might be gift tax consequences when we create a joint tenancy, and that's when property is owned by two unmarried people it's owned jointly. So if property is titled in a name of another non-spouse without adequate consideration, it is a completed gift, and there will be gift tax consequences there. The transfer of life insurance policies can create gift tax consequences if the individual irrevocably assigns all ownership rights to another. It is a gift of the policy to a new owner. The amount of the gift is the cost to purchase a comparable policy on the date of the gift. And then the exercise of a general power of appointment can be a gift tax. So if an individual is facilitating a trust and they have the power of appointment, which allows them to direct where assets are to go, and even if they don't direct the assets to themselves, they direct them to someone else, they have had dominion and control over those assets. So that can create a gift tax consequence when they direct that those funds or that property be paid to someone else. And net gifts also create a gift tax consequence. So net gifts are when one person would like to gift another person an asset, but they don't have the funds to pay the gift tax. So they have a liquidity issue. So in that case, they make an agreement to gift. So say I gift my friend this this land that's worth $20 million. My friend agrees to pay the gift tax for me. The only problem with that is that there will be tax consequences to the giver, or excuse me, to the givee, and the amount of gift tax paid is going to be treated as an amount received by them, and they're going to have to recognize some gain there. So if they have a liquidity problem, they may not be able to pay the tax on that.